Good evening. So the relief rally, whatever it was, has been and gone. And now the reality of US-China trade war is fully setting in. The stocks have reversed sharply from what we saw on Wednesday's historic rally. The Nasdaq had been much sharply lower, so we pulled back quite a long way on all three of the major indices. So the S&P is down about 7% since the Liberation Day tariff announcement. The US dollar suffered its biggest fall since 2022. It was all happening whilst the president was speaking at a cabinet meeting when Mr. Trump acknowledged there would be, as he put it, transition problems.
Everybody wants to come and make a deal, and we're working with a lot of different countries, and it's all going to work out very well. I think it's going to work out really very well. But again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing.
Stuart Kaiser is with me, the head of US equity trading strategy at Citi. Stuart, I'm guessing you are not at all surprised that the relief rally has evaporated and we are once again falling. What was the sentiment? What was the feeling today?
Yeah, Richard, I think, there's a lot of the stuff you touched on, and the fact is there's still very, very large tariffs, kind of hanging out there. China and the U.S. continue this kind of one-up brinksmanship, on the trade war. So, the markets are definitely skittish. I think yesterday, really what it did more was take some of the big tail risks off the table and improve the risk reward a little bit, but it didn't, sort of change the underlying dynamic, which is there are, very large tariffs coming, and those have, negative impact on growth, probably spur inflation a little bit higher. And I think what it really does is it puts really big onus on trade negotiations over the next, call it 2 to 4 weeks, with our key allies in particular. I think they're going to need to show some progress there, because if they don't, the market's going to then start to assume these are more permanent tariffs, and I think then you have to start to price in really big recession risks. So, that's the sentiment, I think, from the floor here.
And the market was already overvalued to start with. We must never forget that. And we had started to have that confluence of events where people were questioning the not the future of, but just the overvalued and profitability of the Magnificent Seven.
Yeah, I think that's 100% right. I mean, you had very strong sentiment, very high valuation. And remember, the market was down about 10%, late February into early March before the tariffs were even announced. So I think to your point, high valuation, high sentiment meant the risk reward was pretty poor. And then you layer on a very surprising, large tariff on top of that. And you can see what the result has been. It's been a very volatile sell-off with a lot of uncertainty.
So the next 3 months, as these negotiations take place, and later in our program we'll be focusing on the non-tariff barriers, but assuming everybody knows what has to be done, the countries coming forward, the US knows what they want to get rid of with each of those countries, if there is progress, can this market live with a 10% general worldwide tariff?
Richard, I think it can, because I think that was kind of the baseline assumption of the consensus at the beginning of this year. And now that we've gone so far beyond that, I think just coming back to it would be a bit of a relief. Obviously, that is still a net headwind for the markets, but honestly, I think something like a 10% across the board was largely assumed as the baseline to begin with. So I think the market can live with that. To President Trump's point, there will be a transition, there will be some hiccups here, but I think if that's where we settle, the markets will be just fine. But I don't know that they have 3 months. I think 3 months of uncertainty is going to have its own impact on economic growth. So, hopefully they can at least be announcing good news and progress in the right direction, before 3 months is up.
I know that my next question might seem a bit weird, but I think you'll know. I think you'll know what I mean. When we get the next earnings season, can we learn anything useful, bearing in mind the sheer amount of noise and disruption? What will we be looking for from companies?
It's a great question. I think these companies have kind of three choices, right?
Yeah.
You can defend your numbers, and if you defend your numbers, I think you better have really good evidence for that. You can kind of kitchen sink it and just sort of price in all this tariff risk and get it out of the way, or you can do, what some companies have done the last week or two, which is just kind of pull guidance. And frankly, that level of uncertainty is quite negative for markets. So I think these companies have a choice between three not great outcomes, and what that probably means is earnings season coming up is going to include a lot of weak or uncertain guidance, and that could be, another headwind for markets. So it's really tricky for companies right now.
And Stuart, hopefully you'll be around to help us understand the earnings season as we get to it and as we go beyond it. I'm grateful as always, sir. Thank you.